Dear 4th grade students at the Department of Economics, welcome to our 5th recorded lecture for the course entitled Economics of Investment and Financial Markets. I hope that you are safe and healthy. Kindly note that the recorded lecture is to be studied in conjunction with your textbook. Chapter 8 of Mishkin and Econs 2012 is concerned with studying the issue of financial crises. Financial crises are major disruptions in financial markets. They are characterized by sharp declines in asset prices and the failures of many financial and non-financial firms. The chapter explains why financial crises occur and why they damage the economy. This chapter develops the framework in which the dynamics of financial crises in both developed and emerging economies are explored individually. Financial crises have been a feature of capitalist economies for hundreds of years, and they are typically followed by the worst business cycle downturns. Examples of financial crises occurred in developed countries include the mother of all financial crises, that is the Great Depression. Moreover, from 2007 to 2009, the US economy was hit by the worst financial crisis since the Great Depression. Defaults in subprime residential mortgage resulted in major losses in financial institutions, with numerous bank failures. With regard to emerging countries, they have experienced many financial crises since the opening of their economies to the outside world in the 1990s. These financial crises include the Mexican crisis, which started in 1994, the East Asian crisis, which started in July 1997, and the Argentine crisis, which started in 2001. A financial crisis occurs when a disruption in the financial system causes an increase in asymmetric information. Hence, to fully understand the current chapter, it's important to resume closely related issues which you previously studied in other courses, including economics of money and banking. These issues include the components of a financial system, the issue of information asymmetry, why the financial system is among the most heavily regulated sectors in an economy, and how to regulate it. In the current presentation, we will also discuss the dynamics of a financial crisis in advanced economies. A financial system consists of a set of financial institutions, financial markets, regulatory and supervisory bodies, in addition to the people who use these markets and financial institutions. I mean the ultimate lenders and borrowers. The users of the system are people, firms, and other organizations who wish to make use of the facilities offered by a financial system. Thus, a relevant question might be, what are the facilities provided by the financial system? As you already know from previous courses in economics, these facilities include intermediation between surplus and deficit units, a range of services like insurance and pensions, a payment mechanism, and portfolio adjustment facilities for changing the composition of wealth. Note that while different parts of the system may specialize in each of these functions, they all have one thing in common. They all have the effect of channeling funds from those who have surplus to those who have a deficit. Flow of funds in a financial system can be channeled either through direct finance or indirect finance. With direct finance, borrowers directly obtain funds from lenders by selling them securities in the financial markets. On the other hand, borrowers can indirectly obtain funds from lenders using financial intermediaries such as banks. Recall that financial institutions fall into three categories. The first category is depository institutions that accept deposits from individuals and institutions, then make loans. An example of this first category is a commercial bank. The second category of financial institutions is contractual savings institutions that acquire funds at periodic intervals on a contractual basis. Examples of this category include life insurance companies, pension funds, and government retirement funds. These institutions tend to invest their funds primarily on long-term securities. This is because they can predict with reasonable accuracy how much they will have to pay out in benefits in the coming years. The third category of financial institutions is investment intermediaries. Investment banks are examples of the third category. Investment banks are also known as underwriters. They play an important role in financial markets. They advise companies and securities to issue, underwriting security offerings, and so on. An important question might be, what is the role of regulatory bodies in a financial system, and why do we need to regulate this system? In order to answer these questions, we need to resume the issue of asymmetric information. Moreover, this issue is closely related to explaining the sequence of events of a financial crisis. Thus, a quick resume of this issue, the asymmetric information, will be briefly introduced in the next slide. Then, we will briefly answer these questions. Information asymmetry is the unequal knowledge that each party to a transaction has about the other party. For example, a borrower who takes out a loan usually has better information about the potential returns and risks associated with his investment projects than the lender does. Due to lack of information, the financial system faces two problems that are adverse selection and moral hazard problems. Adverse selection is the problem created by asymmetric information before the transaction occurs. Adverse selection occurs when the potential borrowers who are the most likely to produce bad credit risks are the ones who most actively seek out a loan. Thus, they are most likely to be selected. Because adverse selection makes it more likely that loans might be made to bad credit risks, lenders may decide not to make any loans, even though there are good credit risks in the marketplace. Moral hazard is the problem created by asymmetric information after the transaction occurs. It is the risk that the borrower might engage in activities that are immoral from the lender's point of view. Engaging in such activities make it less likely that the loan will be paid back. Hence, lenders may decide that they would rather not make a loan. Another example for the moral hazard in the insurance field is that people may engage in risky activities only after being insured. Another way of describing the moral hazard problem is that it leads to conflicts of interests, in which one party in a financial contract has incentives to act in its own interest rather than in the interests of the other party. To overcome the problem of adverse selection, financial institutions screen out bad credit risks from good ones. Moreover, they develop expertise in monitoring the parties they lend to, and therefore they can reduce losses due to moral hazards. We have raised two questions relating to regulating the financial system. Well, regulatory bodies, as you already know, include central banks and other financial services authorities that supervise financial markets such as the equity market. Governments regulate financial markets and institutions for two main reasons. First, regulations aim to increase the availability of information. Presence of asymmetric information among participants of the financial system can lead to widespread collapse of financial intermediaries that is termed as a financial panic. If providers of funds to financial intermediaries have doubts about the overall health of financial intermediaries, they may want to pull their funds out of both sound and unsound institutions. Thus, governments regulate financial markets and institutions with the aim of ensuring the soundness of the financial system. Given that you studied other courses including the economics of money and banking, management of finance and investment, accounting and auditing, thus you are familiar with many of these regulations. Regulators tend to use the following regulations. First, there are barriers to entry. Regulators have created very tight regulations as to who is allowed to set up a financial intermediary. A financial intermediary needs a license to operate. Second, financial institutions and companies whose securities are traded in financial markets must disclose relevant information to stakeholders and to the public. There are stringent reporting requirements for financial intermediaries. For example, their bookkeeping must follow certain strict principles. Their books are subject to periodic inspection and they must make certain information available to the public. For corporations issuing securities, they are required to disclose certain information about their sales, assets, and earnings to the public. Third, there are restrictions on what financial intermediaries are allowed to do and what assets they can hold. To make sure that financial intermediaries will be able to meet their obligations, regulators restrict the financial intermediary from holding certain risky assets, or at least from holding a greater quantity of these risky assets than is prudent. For example, commercial banks and other depository institutions are not allowed to hold common stocks because stock prices experience substantial fluctuations. Insurance companies are allowed to hold common stocks, but their holding cannot exceed a certain fraction of their total assets. Fourth, as you already know from the course of economics of money and banking, depository institutions are obligated to keep a certain fraction of their deposits in accounts with the central bank. Furthermore, organized stock markets are also subject to regulations. Financial assets such as equities are volatile and their prices are likely to deviate from their fundamental values. Therefore, stock markets regulators could use price limits and trading halts to control stock market volatility. As we have mentioned many times during the current lecture, a financial crisis could be defined as a major disruption in financial markets. It is characterized by sharp declines in asset prices and firm failures. Financial crises frequently lead to sharp contractions in economic activity. Recall that the financial system performs the essential function of channeling funds to individuals or business with productive investment opportunities. If capital goes to the wrong uses or does not flow at all, the economy will operate inefficiently or go into an economic downturn. A financial crisis causes an increase in asymmetric information, making adverse selection and moral hazard problems far more severe. Figure 8.1 traces out the stages and sequence of events in advanced economies where financial crises have progressed in two and sometimes three stages. The first stage is called the initiation stage, in which there are several possible ways that financial crises start, such as mismanagement of financial liberalization or innovation. In the second stage, that is termed as banking crises, adverse selection and moral hazard problems become far more severe, resulting in reducing credit. In the third stage, that is termed as debt deflation, firms' net worth declines and therefore lending and investment spending remain depressed for a long time. Let's discuss these three stages in more details. Financial institutions often go on a credit boom, expanding their lending at a rapid pace with lifting restrictions or introducing new financial products. Unfortunately, the managers of these institutions are not likely to have the experience to manage risk appropriately in these new lines of business, resulting in overly risky lending. Moreover, regulation and government supervision may not keep up with the new activities and thus leading to excessive risk-taking. Since depositors know that government-guaranteed insurance protects them from losses, they will supply even undisciplined banks with funds. Eventually, loan losses increase and the asset values, the assets of banks, fall, leading to a reduction in capital. With the deterioration in the balance sheets of financial institutions, lending decreases. Hence, a lending boom turns into a lending crash. As financial institutions cut back on their lending, no one else can step in to collect this information and make those loans. Thus, the ability of the financial system to cope with the asymmetric information problems of adverse selection and moral hazard is severely hampered eventually, and as firms are no longer able to finance their investment projects, economic spending and economic activity contracts. A financial crisis can also begin with an asset pricing boom and burst such as the tech bubble in late 1990s. An asset bubble starts if these assets are overvalued. A pricing bubble can be driven by investor psychology or a credit boom. When the bubble bursts, the prices fall and corporate net worth falls as well. Such a fall in the corporate net worth means that there are less collateral and so adverse selection increases. Furthermore, moral hazard increases as firms have little to lose. The bursting of an asset pricing bubble therefore makes borrowers less creditworthy and causes a contraction in lending and spending. In addition, it can also lead to a deterioration in the balance sheets of financial institutions, causing them to further cut lending. Thus, the economic activity declines. Finally, a financial crisis can begin with a spike in interest rates or an increase in uncertainty. Many 19th century crises initiated with a spike in these rates due to liquidity problems or panics. Recall that individuals and firms with the riskiest investment projects are those who are willing to pay the highest interest rates. If increased demand for credit or decline in the money supply market drives up interest rates sufficiently, therefore interest rate payments increase, leading to a decrease in cash flows of households and firms. With less cash flow, the firm has fewer internal funds. Thus, a firm must raise funds from an external source, say a bank. However, the bank is not sure if the firm will invest in safe projects or instead take on big risks and then be unlikely to pay back the loan. Due to this increased adverse selection and moral hazard, the bank may choose not to lend even firms with good credit risks. Thus, when cash flow drops as a result of an increased interest rate, adverse selection and moral hazard problems become more severe and again limiting lending, investment, and economic activity. Deterioration in balance sheets of banks and other financial institutions lead them to insolvency. If severe enough, these factors can lead to bank panic. Panics occur when depositors are unsure which banks are insolvent. Therefore, all depositors rush to withdraw all funds immediately. Uncertainty about the health of the banking system lead to runs on banks, both good and bad. Thus, banks are forced to sell off their assets to raise the necessary funds. As a result of this fire sale of assets, their prices are likely to sharply decline. Then the bank becomes insolvent. This results in a contagion which then leads to a multiple bank failures and bank panics. With fewer banks operating, information about the creditworthiness of borrowers disappear. Adverse selection and moral hazard become severe. It takes years for a full recovery. The crisis also may lead to a sharp decrease in the price level. An anticipated decline in the price level raises the value of borrowing firms' liabilities in real terms, but it doesn't increase the real value of firms' assets. Therefore, it lowers firms' net worth, that is, the difference between the assets and liabilities of a firm. Such a decline in the net worth leads to a debt deflation. Thus, debt deflation refers to a decline in net worth as price levels fall while debt burden remains unchanged. The further decline in firms' net worth worsens adverse selection and moral hazard problems. Thus, lending, investment, spending, and aggregate economic activity remain depressed for a long time. The U.S. mortgage financial crisis, starting in late 2007, represents an interesting case for studying dynamics of financial crises in developed economies. This crisis spread globally with substantial deterioration in the balance sheets of banks and other financial institutions, and the failure of many high-profile firms. Now it's your turn to follow the analysis we have just discussed to explore the dynamics of this recent financial crisis, which is the worst financial crisis to hit the world since the Great Depression in 1930s. The main concern of the current lecture was to explore the dynamics of financial crises in advanced economies. In doing so, we resumed the components of financial systems that include financial institutions, financial markets, regulatory bodies, and end users that are surplus units and deficit units. Given its importance in explaining the dynamics of financial crises, special attention was given to resume the asymmetric information problem. The presence of such a problem justifies why the financial sector is heavily regulated with the aim of increasing the availability of information and ensuring the soundness of the financial system. A financial crisis in developed economies evolves through three stages. It could start for different reasons, including inter alia, mismanagement of financial liberalization or financial innovation, asset price bubbles, and increased uncertainty. These factors are likely to result in banking crises where banks and other financial institutions fail simultaneously. The resulting decline in the number of banks causes a loss of their information capital, leading to a further decline of credit and eventually a sharp decline in economic activity. In some instances, economic downturn results in a sharp drop of prices which increases the real liabilities of firms. Therefore, firms' net worth declines, leading to a debt deflation. Hence, adverse selection and moral hazard problems become far more severe. so that lending, investment spending, and aggregate economic activity remain depressed for a long time. The recent financial crisis hitting the US mortgage markets has resulted in bursting in housing price bubble. The crisis then spread globally, causing substantial deterioration in banks and other financial institutions' balance sheets, in addition to the failure of many high-profile firms. This is the end of our lecture. Thank you.